Good afternoon once again and welcome to Lecture 4 in relation to IAS 33 earnings per share. Today is our last lecture on this topic and we will be taking a look at the disclosure requirements that are required by IAS 33, and we will be doing this by looking at a question. We will be taking a look at question 14 in your IAS 33 questions handout. As always, we practice exam technique when we go through our questions, so we first read through the required in order to determine exactly what is expected of us. So the required of question 14 is as follows. Disclose the earnings per share note in the annual financial statements of Biggles Limited for the year ended 31 December 2017, in accordance with International Financial Reporting Standards. Note: round all per share amounts to the nearest 2 decimal places and round all other calculated amounts to the nearest rand. Now, what is an earnings per share note? IAS 33 requires that an earnings per share note be disclosed in the financial statements. And basically in this note, we detail two things specifically. We detail a reconciliation of the numerators used in order to calculate basic earnings per share. Now, what is the numerator in the calculation of earnings per share? It's our earnings. So we basically show in this reconciliation how we went from profit to basic earnings. And then secondly, we show a reconciliation of the denominators that are used in order to calculate the basic earnings per share. Now the denominator is the weighted average number of ordinary shares outstanding. So we show how we got to the onezo. The information reads as follows. The following information of Biggles Limited, a company listed on the JSE Limited, is provided to you. Point 1. The balances relating to the equity section of the Statement of Financial Position as at 31 December 2017 are as follows. We have information for both 2017 and 2016. We are given the ordinary share capital, and the ordinary share capital was issued at R1 each. We are given the retained earnings balances. We are given the non-cumulative preference share capital, which were issued at R10 each and have an annual fixed dividend of 80 cents per share. On the 30th of April 2017, Biggles Limited issued ordinary shares at R1 per share in order to obtain funds to acquire 10% of the issued share capital of Manfred Limited. The acquisition of the shares in Manfred Limited was recognized on the 30th of April 2017. On the 30th of September 2017, Biggles Limited had a rights issue to all existing ordinary shareholders on the basis of 1 ordinary share for every 5 ordinary shares held at R9 per share. The fair value of 1 ordinary share immediately prior to the exercise of the rights was R14.40 per share. Assume that all of the rights were exercised on the 1st of October 2017. The non-cumulative preference shares are convertible into ordinary shares at the option of the holder issuer on 30 June 2019 on the basis of 2 ordinary shares for every preference share held. Preference dividends were declared and paid during the years ended 31 December 2017 and 31 December 2016. However, no ordinary dividends were declared or paid during either of these 2 financial years. Profit for the year ended 31 December 2016 amounts to R182,000, and there were no movements in the ordinary and preference share capital general ledger accounts during the year ended 31 December 2016. Now, I want you guys to take a minute and just try and figure out what some of the things that you have been told here actually mean. Take a look at the dates, take a look at the rights issue. What can you tell by looking at the information a little more closely? I'm going to give you a few seconds to think about it and then I will continue. Right, Right, the first thing that should have grabbed your attention is the fact that we have the ordinary share capital balances as at the 30th of December 2017. That's the end of the financial year. So we know that at the end of the 2017 financial year, we have 144,000 shares in issue. We know at the beginning of the year, we would have had 90,000 shares in issue because the closing balance of ordinary share capital in 2016 is the opening balance in 2017. Now we need to go and account for the difference, the 54,000 shares, and we need to go and figure out, well, what is the WANZO that we need to use in the calculation of earnings per share? So that is the first thing that should have caught your attention. We have closing balances of ordinary share capital, so you almost need to work backwards in a sense to get the in-between. Then point 3 speaks about a rights issue. Now we learned in lecture 3 that you can have a rights issue at less than fair value. And when you have a rights issue at less than fair value, there will be a bonus element and a for value element. And we know that the for value element needs to be time weighted, and the bonus element we need to restate the prior period's EPS and WANZO. Now if you just go and look at the information, these rights can be exercised and entitle the holder to a share at 9 Rand per share. But what is the fair value of a share? The fair value of a share is 14 Rand and 40 cents. Therefore, we do have a rights issue at less than fair value, and we will have a bonus element and a for value element. If we had exercised, if the exercise price of the rights were the same as the fair value, or they were exercised at fair value, or whatever the case may be, however it's worded, then you would not have a bonus element and it would all be for value, and then you would just time weight it. Then point 4. Point 4 speaks to the non-cumulative preference shares that are convertible into ordinary shares. But when are they convertible into ordinary shares? Only in the 2019 financial year. That does not affect our year ended 31 December 2017 or the year ended 31 December 2016. Let's first look at the easier part of the calculation, basic earnings. Now I hope you all recall how we calculate basic earnings. We take the profit or loss for the year after tax, less non-cumulative preference dividends if they have been declared, less cumulative preference dividends always. Now we know that in this question we have non-cumulative preference shares, and we were told that the dividend was declared in both 2016 and 2017. Therefore, let's first go and calculate the non-cumulative preference dividend. The non-cumulative preference share capital amounts to 40,000 Rand, and we know that each preference share was issued for 10 Rand. That means that we have 4,000 preference shares in issue in both financial years. The preference shareholders are entitled to an annual fixed dividend of 80 cents per share. Therefore, if we take the 4,000 shares and multiply it by the 80 cents per share, we get that the annual preference dividends amounts to 3,200 Rand. Now that we have the preference dividend, let's take a look at the basic earnings calculation for the 2016 financial year. This one was quite easy as we were given the profit for the year of 182,000, and we have now calculated the preference dividend to be 3,200 Rand. Therefore, basic earnings for the 2016 financial year, if you do the math, amounts to 178,800 Rand. The 2017 financial year is a little more tricky as we were not given the profit for the year. But what were we given? We were given the retained earnings opening and closing balance. And how do we get to the retained earnings closing balance? Well, it's the retained earnings opening balance plus profit for the year, less ordinary dividends, less preference dividends. In this scenario, we have the opening and closing balances of retained earnings, and we have the preference dividend. We know that no ordinary dividends were declared. Therefore, we can work backwards to get the profit for the year. If you do that, you should get profit for the year of 192,000 Rand. Now that we have the profit for the year, we can calculate basic earnings for 2017. The profit of 192,000 Rand, less the preference dividend of 3,200 Rand gives us basic earnings of 188,800 Rand. Now we can move on to the weighted average number of ordinary shares outstanding. Once again, we start off by drawing up our table and putting in what we know. For the shares in issue at the beginning of the year, we know that the share capital did not vary in the 2016 financial year, and therefore the closing balance of 90,000 ordinary shares would also be the opening balance. The closing balance in terms of the number of shares in 2016 becomes the opening balance of 2017. We then know that there was an issue of shares in exchange for a minority interest in a company. And then we also know that there was a rights issue for less than fair value, which means that we will have a for value element and a bonus element. We then also know that at the end of the 2017 financial year, there were actually 144,000 ordinary shares in issue. Let's quickly take a look at how the rights issue has impacted the number of shares at the end of the 2017 financial year. With regards to the rights issue, 1 ordinary share was offered for every 5 shares already held, and all of the rights were exercised. If there were 5 shares already in issue, and we then issued an additional 1 share, there are 6 shares in issue. Therefore, the 144,000 shares represent 6, and we want 1. Therefore, 144,000 shares multiplied by what we want over what we have, multiplied by 1 over 6, gives us 24,000 shares issued in terms of the rights issue. 144,000 shares at the end of the year, less the 24,000 shares issued in terms of the rights issue, means that we had 120,000 shares just before the rights were exercised. If we compare the 120,000 shares to the 90,000 shares at the beginning of the year, we then know that 30,000 shares were actually issued in exchange for a minority interest in another company. The exchange of shares for a minority interest falls into the for value category, and therefore we need to time weight the number of shares. The acquisition was recognized on the 30th of April, and therefore we had the shares in issue for 8 months. 8 over 12 becomes our time weighting factor, which results in 20,000 shares to be used in the 2017 weighted column. Let's now take a look at the rights issue in order to determine how many of these 24,000 shares were issued, form part of the for value category and the bonus element. We know that before the rights issue there were 120,000 ordinary shares with a fair value of 14 Rand and 40 cents each. That then gives us a total Rand value of 1,728,000 Rand. We then know that we issued 24,000 shares in terms of the rights issue, and these rights were exercised at 9 Rand per share. That then gives us total proceeds from the rights issue of 216,000 Rand. That means in total we have 1,944,000 Rand for 144,000 shares. We know that in order to calculate the for value portion, we have to take the proceeds from the exercising of the rights of 216,000 Rand, and we have to divide it by our X rights value. Based on the table, our X rights value is 13 Rand and 15 cents. That then means that 16,000 shares of the 24,000 shares actually issued in terms of the rights issue were for value. If we then go and compare the 24,000 shares actually issued to the 16,000 for value, we then get 8,000 shares that form part of the bonus element. Because these 8,000 shares form part of the bonus element, they were deemed to be issued for no value, and we therefore have to go and restate the prior year's EPS for these bonus shares. Now that we have calculated what portion of the 24,000 shares is for value and what portion is the bonus element, we can now go and complete our little table that is used to calculate the WANZO. So if we go and look at specifically at the rights issue, if we look at the for value portion of 16,000 shares, those 16,000 shares were actually issued in 2017. Therefore, the full 16,000 forms part of the 2017 actual column. However, we know that we did not have all 16,000 of these shares in issue for the full year, and because it was for value, we have to time weight these shares. So we time weighted by 3/12 because they were actually in issue for 3 months. So if you take the 16,000 and you multiply by 3/12, you then get your 2017 weighted amount of 4,000 shares. We now have to move on to the bonus element. Now the bonus element amounted to 8,000 shares. Now in the prior examples that I did with you in lecture 4, because we had the same amount of shares in issue immediately before the rights issue in the actual, the weighted for the current year and the weighted for the prior year column, we didn't have to go and do what we're about to do now. We have to go and almost restate the bonus element to be in line with the number of shares that we had before the rights issue took place. So that 8,000 corresponds with the 120,000 in the 2017 actual column. But if we go and look at the 2017 weighted column, immediately before the rights issue, we had 110,000 shares in issue and not 120,000 shares in issue. So in order to get the bonus element applicable in the weighted column, we take the 8,000 shares actually issued in terms of the bonus element, we multiply it by what we had in the weighted column before the rights issue, being 110,000 shares, and we then divide it by the 2017 actual column shares in issue before the rights issue of 120,000 shares. That means that the bonus element calculated in terms of the 1-0 is 7,333 shares. The same thing is then applicable for the 2016 year because we always have to restate the prior period's earnings per share as soon as we have an issue for no value. So here in the 2016 weighted column, we had 90,000 shares immediately before the rights issue, whereas the actual column had 120,000 shares. So we need to restate those 8,000 shares to almost be comparable to the 90,000. So in other words, if 90,000 shares is what we had in issue, that bonus element of 6,000 corresponds to what the total rights issue would have been had there actually been 90,000 shares in issue before. So in order to get that 6,000 Rand, we take the 8,000 shares actually issued in terms of the bonus element, we multiply it by the 90,000 that we had in issue, and we divide it by 120,000, which is what was actually in issue before the rights issue. That then means in 2017's weighted column, we are going to have a 1-0 of 121,333 shares, and then in the 2016 weighted column, we are going to have a 1-0 using 96,000 shares. Now, on all of the previous slides, you saw calculations. The calculations do not equal the disclosure as required in this question. This question asked us to prepare the earnings per share note, and at the very beginning, when we first read the required, I said the earnings per share note is twofold. The one part is the reconciliation of the numerators used for basic earnings per share, and the second part is the reconciliation of the denominators used for the basic earnings per share. So if we first go and look at the reconciliation of the numerators used for the basic earnings per share, we provide the information for the comparative period, being the 2016 financial year, and then you literally perform the calculation of basic earnings. So you start with your profit for the year, you deduct your preference dividend on your non-cumulative shares because they were declared, and if we had had a preference dividend on cumulative shares, because we always deduct that, that would have been deducted too. So that then shows that in 2016, we worked with a basic earnings of 178,800 Rand in order to get the EPS. And in 2017, we worked with an earnings of 188,800 Rand in order to get the EPS. That is then the reconciliation of the numerators used for the basic earnings per share. We then need to do the reconciliation of the denominators used for the basic earnings per share. Now here, you just state the weighted average number of ordinary shares outstanding, and you then must please reference your calculation or reference your big table so that we know where you got that 96,000 and where you got the 121,333 Rand. Now, this is the basic disclosure. There are a few more questions in your question pack asking for the earnings per share note for the financial statements. Please go and take a look at these questions. Also go and read through the disclosure section or the disclosure paragraphs in IAS 33 just to make sure exactly what needs to be presented in an earnings per share note. That then brings us to the end of Lecture 4 and the end of IAS 33 earnings per share. If you have any questions regarding this topic, please do not hesitate to contact us on email at frk201consult@gmail.com, or you can post a message on the Facebook group and we will respond as soon as we see it. Otherwise, have a lovely afternoon, good luck with the exam prep, and I will see you all soon for your next few topics. Bye for now.